All right, folks. Well, listen, we're going to get started here on this beautiful Tuesday, fall. Is it fall? Fall afternoon, I guess. Welcome back. We took a break here in August. This is the first session back since we last spoke, I guess, in July. Lots of interesting events that are going on this week. Obviously, namely, probably the most important one is the US Fed and Bank of Canada, what their rate policies will be. That'll be coming out in 24 hours. Which we're all eagerly awaiting. So I'm going to jump right into it. Again, typically in the past, I would only have one of these in the fall, one of these sessions. But given that we've gone to a monthly rotation, some of the things that I generally talk about, which is what are some of the tax items that we might want to be considering between now and the end of the year, I've actually omitted that. I'm going to actually share that probably in the next session in October or November. And so today will be a little bit shorter. I'm going to aim to probably chat for about 35 minutes, which is a little shorter than usual. And then the other thing I'm going to encourage is if folks have questions, you can type it into the Q&A section, which you can generally find if you're on a laptop. It's across the bottom. There's a ribbon. It'll say Q&A. So you can type in any questions that you might have as we go along. I could answer them kind of throughout the session if there are things that are pertinent to what I'm covering. Otherwise, I'll just save it to the end. All right, so loose agenda today. We're going to just talk kind of general economic comments. Again, we'll probably focus more so on just what's been happening over the last 6 to 8 weeks and what we think is going to happen here in the near future. Obviously, spend some time on monetary policy, and then kind of what's next. What should investors be thinking about between now and, I wouldn't say end of the year, but probably over the next 6 to 8 weeks. So, I always start with these. Biggest secret that everybody knows is we anticipate rates, obviously, being cut tomorrow. US Fed, it'll be the first time they cut in quite some time. They're probably one of the slowest central banks to actually change monetary policy when it comes to interest rates. So let's jump into it. So where are we today? So when we look at the US and Canada, I'll spend the majority of the time on North America. This chart here shows two things. One, it shows inflation rates, and it also shows lending rates. And so when we look at Canada, Canada is actually now under the target of roughly 2% on the inflation side. It has ticked up. We just got some data just recently. It's come up a little bit, I think 1.9%, but still below the target, which is positive. I still think that leads to to Canada cutting a rate again, potentially by the end of the year. On the US side, they haven't cut really at all in 2025. Last time they cut was late last year. And their inflation rate has been coming down. But what's been problematic, we've been talking about it for a while. We do think that the tariffs will obviously bleed into the inflation rates. And here we are, we're seeing it today. I've noted that here. You can see inflation over the last couple months has been actually ticking up. And it's really no surprise when you actually look at the tariff rates by country when you look globally. I wrote a couple weeks ago in my commentary about Canada, despite the tariffs that we have between us and the US, still one of the lowest globally. But if you actually look at the trading partners of the US, some of the largest trade partners, China is one of them, has the highest imposed tariff rates. So no surprise whatsoever that we're starting to see inflation tick up a little bit. We've been anticipating it. I think why it's been so long, or it's been 6 months or so since they first announced the trade policies, is a lot of companies were quote unquote front running the tariffs. So what they were doing is they were buying a lot of inventory ahead of the tariffs, got ahead of the game, and they've been working through that over the last number of months. And now we're getting to a point now where, they've worked through that inventory. And number two, a lot of companies were absorbing some of these tariff related costs. And now we're starting to see it actually trickle down to the consumer. Hence the reason we're starting to see an uptick in inflation. So what else is on the agenda for the US Fed? Obviously the big one that we've been watching closely is the jobs data in the US. Lots of info in the news. Obviously, if you've been following it, there's been a lot of revisions on the US job market or job data over the last 2 to 3 months, to the point where June actually posted negative growth. So significantly down trended or revised to the downside in the US. Unemployment rate is rising. So I think from a U.S. Fed, they're obviously been cautiously waiting to see how tariffs were going to affect inflation. But where we're at right now is we're starting to see their job market deteriorate, and obviously the U.S. Fed wants to get ahead of that before it really gets negative for them. So we believe that there will be rate cuts. I'll come back to that in just 1 second. In Canada, it's kind of the same story. If you look from the beginning of the year, we did have job growth, which is over the last couple months has since eroded. We're basically flat for the year. Unemployment rate here in Canada is around 7% and has been ticking up for the last probably year to year and a half. But obviously the Bank of Canada has been much more aggressive in their rate policy, and obviously we're sub 3% now on the interest rates. So what is the likelihood? What's the likelihood of the US and Canada cutting? Well, let's look at, what the US Fed has to look at before they get to that decision. So really, I think policy guidance, and again, right in the title, is critical. The markets are likely pricing in a rate cut. And I shouldn't say they're likely pricing, they are pricing in a rate cut tomorrow. The question is, are we getting a 25 basis rate cut or 0.25%? Or will it be a jumbo rate cut at 0.5%? Okay. If you looked at the data when we had the job data that was released, a few weeks ago, the likelihood of a 50 basis point, 0.5% rate cut was pretty much zero between now and the end of the year. After the job data revision, it actually, there was a higher probability of a 50% or a 0.5% rate cut. Still not highly expected. We actually think there's likely going to be a 25 basis rate cut tomorrow. But again, Powell needs to be careful. Every time they talk about cutting rates, the markets have gone up. Every time they have, monetary policy has tightened, whether it's through trade or not cutting, we can see the impact it's had in the markets. Okay. So when we look at G10 banks, and these list all the major ones, but I'll focus on the US and Canada just as a comparison. If we look at the US, they were one of the very first central banks to actually cut. They cut last year, and that was pretty much it. They cut a couple times, and they've been stuck around 4.5%. Canada, on the other hand, we can see here started cutting shortly thereafter and has continued to cut all the way into this year. So there is a likelihood of getting a 25 basis point cut, but I think we're nearing the end in Canada versus the US, which is actually just starting. Now, if the US comes out and is a little bit more dovish than we expect, perhaps the markets will react unfavorably because we're anticipating things to be negative, and therefore we're going to expect rate cuts. So here's the market expectations. I alluded to this earlier, but here's the two charts that we'll go over. So when we look at Canada at the top here, again, we can see if we go back over the last 7 years, we can see we were at all-time low interest rates coming out of the pandemic, both in Canada and the US, which we look here at the bottom. But into 2022, as we battled inflation, obviously central banks increased rates pretty significantly, and Canada's come down pretty sharply. And you can see here, as I mentioned, I think we're near the end stages of rate cuts. Again, maybe we see 25 basis points between now and the end of the year, maybe 50 basis points, but I think we're going to fall somewhere in line between 2 and 2.5%. The US, on the other hand, because they've been so slow to cut, and again, part of it is because of the administration's trade-related policies, it's really tempered the US Fed to cut. They've already been data-driven, watching to see the impact of tariffs on inflation, and again, we are seeing that pick up. But again, US jobs have not been great. They've weakened, which I think is gonna prompt the Powell to actually cut tomorrow, and not just tomorrow. We can see actually probably between now and the end of the year, we're gonna likely see other rate cuts. Definitely a sharper decline in rate cuts between now and the end of the year. Now, again, if we don't get rate cuts at the pace as what we're expecting, then I would imagine the markets will get a little bit choppy because they're pricing in at least a 25 basis point cut, if not 50 basis point. So what does this mean for an investor? from timing policy changes. You know, if you had money and you're going to invest, they're going to make changes. You know, do you change today or do you wait? And this is the conundrum that everybody's been facing. You know, if you invest now or be more aggressive today, you obviously benefit if the markets keep trending upwards. Growth sectors and housing often do well when rates fall. So we anticipate the same thing. You know, if rates do fall, we think the growth companies, especially the ones that are driving the markets right now, you know, money will be cheaper for them to borrow. Perhaps we see more share buybacks in the markets if money continues to get cheaper. Obviously, the drawback, markets can pull back if the Fed is just less dovish, if they're actually more positive on the economy than what we anticipate. The reason why that affects the markets, obviously, is if monetary policy stays the same or tightens or doesn't loosen as much as what we anticipate. It just means there's not as much money in the within the environment for people to borrow, etc. Now, if you wait for the cut, which again is 24 hours away, the benefit, you know, obviously, is we avoid potential declines if it's more modest. At this stage, like I said, there's nothing we can do because it's after market today anyways. But, you know, in the US, you know, it's not just about today's or tomorrow's rate cut. It's about the ones that happen there on out for the balance of the year. Drawback, obviously, is you can miss out if stocks rise leading up to the decision, which, you know, we've had slow and steady growth, notwithstanding today. And then sitting on the sidelines obviously means safety, but also opportunity cost. The reason I put this slide in here, folks, is there's a lot of investors in Canada, maybe some on this call, that are still holding on to the high interest rate environment that we saw in 2022, 2023. So they're sniffing around for low risk investments with higher yielding interest. The problem is, as rates come down, that is no longer going to be the case. So there's going to be a lot of investors across the country that essentially are going to be having GICs renew, and they're going to be having to look at what else can I do to generate income to offset that. And I have a couple slides at the very end I'll chat about as well. So again, going back to just sentiment, one of the things that we're seeing in the markets, and I'm going to unpack this as we chat for the back half of this session, is, you know, markets continue to push new highs. And I read a good quote that has said it's only a new high until a new high is achieved, which is true. And so we're seeing these small incremental gains in the market that keeps pushing it higher and higher, although it's very nominal. But it's all those small little wins that actually add up over a period of time. So when we look at investor sentiment and we look at bulls versus bears, so if we look at this actual chart down here, we can actually see it's very neutral. You know, there's been periods since 2020, 2022, and so on, where we had excessive kind of bear market sentiment, which is below. And then we've also had, you know, bull market as well. So we're coming off, here's where the trade tariffs were in here, and we're very neutral. So when we look at the general sentiment of investors, it doesn't seem overly excessive to being what we call bullish. Now, what happens when markets are at near all-time highs? So, you know, from an investment point of view, you know, some people might say, hey, maybe I'm going to pause or hang tight to invest, because if we're at highs, maybe I'm going to wait for it to pull back and then I'll invest at that point. That is one option. The challenge with that is that we can't predict it. Warren Buffett can't predict the markets. You know, he invests throughout market cycles, whether it's good or bad. And so when we look at this chart here, what it shows is over a 1, 3, and 5 year period, if you were to invest when the market was at an all-time high, which is the orange line, versus all other dates over the last almost 50 years, the result is very similar, okay? And that's if somebody has a mid to long-term time horizon. If it's short-term or you have a shorter time frame, you probably shouldn't even be in the markets anyways. But if you were to look at that, those numbers would likely be a lot different. Okay, so again, when you have mid to long-term time horizon, you know, even if we get a pullback over the long run, and we saw this in March and April this year, we had a significant pullback, and here we are, you know, 6 months later, where the markets have made up a lot of that decline and are pushing these new highs. And then the other thing we can look at is how have asset classes performed after a rate cut. So what happens when markets are high? What happens when the central banks cut rates? Okay. Generally speaking, growth stocks tend to be some of the stronger investments. Alternatives are another ones that generally do quite well as well. But as you can see, regardless of the asset class, some do better, some do not so good, but they're still all positive over the long run. So these are the 1-year performance of various asset classes. So even if we do get some volatility here in the short term, we think it's going to be short-term volatility, and the mid to long term is still going to be quite positive. Okay, so I'm going to wrap that section on rates. I just had a question, isn't here? Let's see what we say here. Oh yeah, there, and this is a good comment. One of the things they're talking about is just I can not only consumer debt but government debt at these rates. There is a benefit. There is a motivation for governments to get interest rates lower, because obviously it affects their borrowing. Right now, it's actually quite costly in the U.S. They were downgraded earlier this year. But by all means, like I said, this is why we think we're going to get a good rate cut tomorrow, minimum 25 basis points. All right, let's actually look beyond interest rates. Let's just talk a little bit about just investor emotion, what they should be thinking about. Not even emotion, but what we should be thinking about with our portfolios. This is what I think about my portfolio. So when we look at leading objectives for investors, obviously everybody wants the markets to go up. They want portfolios to go up. That's the general trend, okay? But ultimately, humans, we're 4 times more motivated on the fear of loss than we are of the greed of winning. So when we look at this survey, 2 of the top 4 objectives for investors is risk management and wealth preservation. And so I don't know what the future holds in the short term, but I know we have to continue to manage not only expectations, but also what we've worked to actually grow over the last number of years. So managing risk and wealth is actually extremely important. So we want to be mindful with whatever we do on behalf of the clients. Obviously we want to have good experience on the upside, but we also want to protect on the downside, because we recognize volatility isn't going our way. So I've been chatting a little bit over the last, actually my commentaries in the month of August, I talked about the alternative asset space. And here's a really good example. I came across this, and I just thought I'd talk about this mandate of the 60-40 or the 70-30 portfolio, which would be considered a balanced investment, okay? Now, generally speaking, a balanced investment with traditional securities or investments is made up of stocks and bonds, or they're made up of proxies that include stocks and bonds. So exchange-traded funds or ETFs, that the underlying investments are stocks and bonds, maybe pooled investments like mutual funds or segregated funds, or so on. Well, what's interesting is that these asset classes, which were generally negatively correlated for the last 2 decades, since the early 2000s, they're actually reverting back to the mean. And what we're seeing is that stocks and bonds are becoming more positively correlated. And what that means is they tend to move in a similar direction. So if you go back to 2022, equity markets were down between 10 to 30% in North America and globally as well, because of high interest rates and inflation and so on. So generally speaking, when we see that in the equity markets, there's this rotation of assets that go from equities into more conservative investments, whether it's cash or fixed income or bonds, okay? Hence the 60-40 split, 70-30 split. Well, that year, bonds fell between 10 to 15%, because as interest rates rise, bonds generally go down. So here we had a phenomenon where we had both equity markets and bond markets both declining, okay? And what that's done is it's actually increased the level of risk in this more conservative, more balanced type of approach. So they've gone from a 7 standard deviation to a 12, which is 6% on set. It's almost 100% more volatile as what it was from 2016 to 2019. Okay. Now, standard deviation, we do talk about that often when we're on the phone with our clients and so on. But standard deviation is just simply a measurement that we can use to quantify risk. And on its own, it doesn't mean a lot. If I said to you, you have a 7 standard deviation, it probably doesn't mean a heck of a lot. But if I start to use that to compare to other investments or other proxies, and I said, hey, this investment here has a standard deviation of 10, and it returned 10%, and yours is a standard deviation of 7, and you return 9%, we would rather go with the latter portfolio, where the gap between return and the risk is wider than the other one. It means you have a more efficient portfolio. So this is one of the things that we look at when we're actually looking at our client portfolios. We say, hey, how much risk are our clients taking to generate the return? And again, we want to be mindful of that. All right, so here's where we are in the market cycle. So today we're in September, middle of September, generally the worst month of the year, which is no surprise when you think back about 2008, 2009, and so on. Even last year, September wasn't a great month. But when we go October, November, December, some of the strongest months of the year are actually ahead of us. Okay, even January is pretty good. So we actually think from a forward-looking point of view, we actually like what's ahead, even though we're some economic uncertainty with jobs, economic uncertainty with rate cuts, even though we know they're coming. We're at all-time highs. Again, there's a lot of reasons why we can continue to remain cautiously optimistic. And here's one of them. Here's a couple of them I'll walk through. So most of you on this call have seen this chart before. This is the wave of innovation. I talk about it often. The way we live our lives today is changing at a rapid pace. Okay. The last 5-10 years, even just since COVID, think about how technology has advanced, how we communicate with people, how easy information is accessed. It's at our fingertips every single day. Well, right now we're in the early stages of kind of this sixth wave, which is kind of the AI kind of robotic type innovative wave that we're going through. And this is what we're seeing with a lot of these, kind of growth, quote unquote, growth companies in the US. So the Mega 7, things like Amazon, Apple, Meta, Microsoft, and so on. These are companies that are actually, pushing the markets forward because of the impact they have in this kind of innovative wave. Now, what's problematic with that, and we recognize it, is things are becoming less diversified in those spaces. So as an example, the NASDAQ has always been tech heavy. Okay. Well, those Mega 7, Mega 8 names represent almost 60% of the NASDAQ market today. And on the S&P 500, same thing. We always have, a handful of companies in the top 10 that might represent 20 to 25% of the overall market. Well, today, those 7 to 8 companies represent almost, if not more than a third. So we have to be mindful when we're owning certain investments, we ought to make sure that they fit properly together. Otherwise, we could own 3, 4, 5 different investments, but if they're all investing in the same things, we have a lot of concentration risk potentially. Okay. Now, why this is relevant, and I can make actually one other comment before I move on to the next slide. With those 7 to 8 investments that I said are generally more growth oriented, what's interesting is companies like Microsoft and Apple and some of these other ones that are paying 2 to 3% in dividends, believe it or not, they're actually starting to be included in value type investments because they are paying dividends. A lot, if you look back 5, 7, 10 years ago, a lot of these quote unquote tech companies, they wouldn't pay dividends. Okay. So again, going back to the US, people ask, especially in March and April, when we were going through, the comments from Trump and Canada being the 51st state, and should we be owning US investments? I said, yes, we have to. We have to, because when we look at where we are in this wave of innovation, 8 of the top 10 companies reside in the US. Okay. Well, we fast forward and we look at, US startups in comparison to the rest of the world. In the US alone, there are more quote unquote unicorn kind of venture startup companies in the US than all of global combined. Okay. So we can't just, kind of rear view mirror the US market. We have to look at it for what it is, despite the noise that's going on globally or economically, because the companies that are in the US are the leaders of what's going to actually propel us forward. So I'm not suggesting we all run out and buy US companies, but I'm saying we need to continue to own US companies as part of the overall mix of a portfolio. All right, last couple of slides. So the next slide here I said earlier, is there reasons to be optimistic? Okay, the answer is yes. So when we look at earnings season, folks, so earnings season in Q2 was really positive. 79% of the S&P 500 beat analyst estimates and 80% beat on earnings. The average of those two categories, generally speaking, on the S&P 500 is 60%. So not only did they beat it, they largely exceeded it. and we anticipate earnings season to continue to grow. So despite the labor market and things that are kind of slowing down in parts of the economy, the engine that we call kind of the US corporate world is actually humming along pretty well. And if rates get cut, again, these are other reasons why we think these corporations will continue to be profitable. The biggest challenge I think that they have is they might become their own worst enemy. And we saw this with Apple in their heyday. And obviously Apple's still a big company. But in the early stages of Apple, when you go back to between 2010 and 2020, when they were exceeding expectation quarter after quarter after quarter, the problem wasn't whether they were going to be profitable, but it was whether they could continue to beat their expectations. So I remember one quarter, and I can't remember the exact numbers, but as an example, I think their expectations were like 56 billion in sales for one quarter. And I think they came in at 54 billion. And they had lots of profit. And yet their share price went down pretty significantly in a short period because the expectations moving forward were, can they keep this pace up? Is this a one quarter blip, or is this things to come? So here you had a company paying a dividend, had billions, over 100 billion in cash on the books, and they still did over $50 billion in sales, and their share price was getting compressed because of expectations. So hopefully they can continue to meet or exceed, because even if they smash their numbers, but they don't exceed, we could still see some pullbacks. Okay. All right, I mentioned my last couple slides. In general, I wanted to talk a little bit about the interest rate environment and what this means for a lot of retirees or Canadians in general as they search for yield. The challenge is, as rates come down, obviously the easy yield, the GICs and so on, it's going to be gone. Okay, you might be able to get a teaser rate for maybe 3%, maybe somewhere for a short period, maybe 30 days to 90 days potentially. But generally speaking, a one-year GIC in Canada is going to be sub 3%, probably closer to 2.5%, and it's going to continue to trend downwards as rates come down. So if inflation is 1.9 or 2, after tax, investors are actually below the inflation rate. That's problematic. And a lot of investors, they used to own dividend yielding investments, but they've migrated to interest-bearing investments because we lived through a 4 or 5% interest rate period in 2022, 23, and even a little bit in 24. So what do we do now? Well, I know what I've done. I've actually searched out, and I've started to include, for a portion of my portfolio, dividend-paying securities. And we already do that with our clients. But I recognize that, hey, if I can get 4, 5, 6% in a company that pays me above and beyond their growth, and that 4, 5, 6% is treated as a dividend instead of interest, the taxation on that distribution is also lower. It's tax preferred. So we've been watching, obviously, value stocks and a lot of these industries and sectors in Canada. And in the last quarter, our big six banks reported really strong earnings and strong guidance. So as an example, in this chart here, this is the big six banks in general. They've actually reduced their provisions for loan losses. So you can see here Q2 2025 versus Q3 2025. They still continue to have provisions, like whether we have high interest rates or not. There's always loan losses that they plan for. Unfortunately, that's just the nature of the business. But we can actually see the provisions that they would generally have for those coming out of a high interest rate environment where the fear was that there could be more foreclosures or defaults. They are confident in what's going to happen on a go-forward basis, where they feel they can actually adjust that downwards. Okay, and when we look at what their kind of tier 1 ratio, which is a requirement for our big six banks to be funded with essentially cash, and this is one of the reasons why they're so stable. Generally, we have this regulatory minimum of 11.5%. Well, if we look at the big six banks, Bank of Nova Scotia, Bank of Montreal, CIBC, National, Royal, TD, every single one of them are up significantly above that regulatory minimum of 11.5%. Okay, this actually bodes well for stability, which is what we like. Number 2, it bodes well for consistency of their dividends on a go-forward basis. Not so much the consistency, because I'm really confident in the dividends that pay out from our banks, but the benefit of actually having this flush with cash is that the ability for them to increase their their dividends, it's on the table, which is a positive thing. Okay. The other benefit they can do is they can also do share buybacks because they have more cash. So if they want to essentially improve their share price, they can actually use that cash to buy back shares. We see that a lot in the US, the share buyback. And that's another way that investors can actually participate in gains because essentially there's just less shares on the market to trade. Okay. So again, dividend type producing investments, but even beyond the big six banks, I believe is a place that we need to be for a lot of our clients. So when we talk about diversification, I've talked about 3 asset classes. I've actually talked about really 5 asset classes without really talking about it. So we have the traditional stocks and bonds, which I talked about the US side, US and Canada, talked about more dividend or value on the Canadian side, more growth on the US side. But I also talked a little bit about, investing beyond just traditional stocks and bonds. So private equity, private real estate, private infrastructure, private credit, which a lot of folks on this call have some form of investments in those. And that's one of the reasons we've been able to really manage risk on the downside, reduce that standard deviation that I talked to, and generally I can provide some pretty good results despite the uncertainty that's happening in the markets. So moving forward, last slide, and then I'm going to open it up for questions. So please type it in if you have a few. So again, summary key things for the balance of the year for us, and perhaps I shouldn't have said balance of the year. I should have probably said balance for the next 6 to 8 weeks, because again, things can change so rapidly. But number one, obviously focus on quality, regardless of what we're investing in. We want things that we believe are good quality investments. Number two, valuations. I talked about this earlier. Are things reasonably priced? I think for the most part, things are a little high. But when you look at it in comparison to peers, I think they're pretty well in line, especially given the fact of where we think earnings season will take us, the trend. And then again, if we're not quite 100%, we need to have high conviction. So especially when you look at some of those big 7 names that are driving the markets, driving the growth of the economy, some of those valuations might seem a little bit out of sorts. But again, if we have high conviction with some of these companies, I think about a company like Microsoft. I'm not saying to run out and get it, but Microsoft or Apple or what have you, these ones that are innovating and they have their hands in the AI sector and so on, these are ones that are going to lead us in the next 5, 10, 15 years. I truly believe that based on where things are going and how we lead our daily lives. And then last one, again, diversification is critical. Again, we've talked about different asset classes and managing risk. So again, last piece is volatility. It's inevitable, it's uncomfortable, but it is totally normal. This year has taught us anything is that, despite what happens in the markets, markets do react they're very predictable in how they react to negative news. But over time, fundamentals will generally prevail. And that's what's happened this year. If you would have closed your eyes January 1, you would have opened your eyes September 1st, you would have thought it was a pretty good year. But it's been a heck of a journey to get from A to B. And I would anticipate that to continue here in the near term. But again, I think there's a lot more reason for being generally optimistic than to be pessimistic. Okay. So I'm going to wrap there, folks. I have a couple questions that are coming in here. If you want to try and get a question answered, please type it in. I'm going to actually just have a look. What does this one say here? Yes, I actually have somebody that asked about infrastructure funds. And yes, actually, so in our private real estate and infrastructure holdings, they have actually started to add infrastructure investments in the Foresight private real estate portfolio. I know our private market team has been actively researching different infrastructure. Generally speaking, we prefer to own some of these types of investments collectively through sub-advised agreements, so we can spread the risk out for our investors. But private infrastructure is something that is top of mind. We think the yields on them are great. The other challenge on from a retail point of view for a lot of folks on this call is a lot of these companies are these invested or sub-managers aren't accessible for retail clients like us. So the only way that we can actually get to participate with them is through it's kind of these sub-advised investments. And so I'll give you a really quick example of one of the ones that was added to Foresight in the last 6 to 8 weeks. Excuse me. I don't know if you guys remember, but early in Trump, when he took office, he had a really big announcement. It was more so on AI investments within the US, and he put a structure in place where he was saying they were going to actually invest close to $500 billion in AI type focused investments. Okay. Well, one of those big ones was a development. I believe it was I think it was in Texas. And one of the investments that has since been added to Foresight is a company that actually has participated in that infrastructure investment in the AI world. So our clients actually have exposure to some of this infrastructure that's happening and some of these spending bills that are happening in the US as well. All right, another question here. Core inflation strip. So yeah, so somebody was asking about core inflation rate because data strips out more volatile sectors. So I generally what I say is, is our core inflation rate really at 1.9%? I usually just use a real life example. If I were to go to the grocery store, I really don't believe it's 1.9%. Every time I go with my wife, I think my reaction is exactly the same when we get to the checkout and we get the bill. There's less and less items in our bags. And it just boggles my mind how expensive everything is today. So, in the real world, I believe it's higher than 1% or 1.9 or 2%. From a data point of view, they say it's 1.9%. But yeah, like I said, there's no way. There's no way it's been only 2%. And you also have to look at too is when they report this data, it doesn't go back to a year ago and say it's 1.9% from a year ago. If we've had significant inflation up to now, then again, it's kind of a rolling number. So yes, I would believe that our inflation number is higher, but the only caveat to that is they're consistent in their reporting. So, this month to last month, I mean, I would think it's fairly similar, but in the real world, it's much different. So, all right. Okay, I don't really have too much other. I have one other one that talks about housing. I can comment a little bit about that real estate. So most recent data that came out in Canada, which I thought was interesting. We're seeing a lot of news about our real estate market, about maybe is it softening. I do believe there are more homes on the market. But I don't think it's really falling excessive. You're getting homes that were once priced at 3 million that are now 2.8. So yes, they're coming down, but they're still higher than what they were 5 years ago, generally speaking. If you look at the housing data with new housing starts, the most recent data is actually it's on the trend upwards. So we were going through a period of time where housing starts were actually shrinking in the country. And now here we are, as we look at, as we head into the fall, we're actually seeing an upward trend in new housing starts, which I think is positive. We have a lot of glut in the condo market. Obviously, that's top of mind. But generally speaking, like I said, I think our real estate market has been pretty resilient thus far. There's a lot of folks that are still renting. There is, I think, going to be an opportunity if rates do come down. Perhaps you might get a little bit more buyers in the market, which might be a good thing as well. But generally speaking, the real estate market has been somewhat resilient, and I would anticipate it to continue to stay fairly strong between now and the end of the year. So, all right. So that wraps it, guys. Like I said, we're all done questions. Thank you for the comments. I've been getting some folks in here that have been saying, hey, this was a great presentation, great data. I always appreciate people's feedback. If there are topics that you'd like me to cover in future ones, I am happy to do it or add it to the presentation. Like I said, today was a little bit of a shorter one, which was actually kind of nice, to be honest. We don't have any guest speakers on the agenda. I don't have anybody at this point. I will give us some thought if there are any areas where you might like to see maybe me go out and try and find somebody to join me. I'm happy to do that as well. And then the only other thing I would say, if you have family, friends that are feeling a little uneasy on the markets or the economy, which I wouldn't blame them, feel free to pass their name on. I'm happy to have a conversation. It doesn't mean they have to become a client, but I'm happy to give them a quick assessment on some of the things that they maybe should be considering. Generally, when I sit down with folks, it's not one or two things I find that they need to be looking at. It's generally 6, 7, 8, 9, 10 things that people are overlooking in their financial situation. So, we have folks, you're in good hands. We obviously address these when we do our planning meetings, but again, feel free to extend our number to your friends and families, or send me an email with the introduction, and we'll reach out and see if we can help them as well. So with that, thank you guys. Have a great day. Enjoy the weather. I think this might be the last kick of the can this week. And then I think we kind of get into some rain. But overall, have a great week, and we will catch you during the next session. Take care, guys.